Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today, we're talking about cash value life insurance and how you can use it to build serious wealth.
How to use your cash value life insurance as your own bank and own finance vehicle.
Is this an appropriate tool for you, doctor? The Susie Ormans and the Dave Ramseys of the world, they're not talking to you.
Today, we have a listener question, and it's about cash value life insurance and how to use it to build wealth. This one comes from a doctor named Luke, and like so many of the doctors who come to us, he has enough information to know that there's something there, but he doesn't have quite enough to put it all together for himself. So he's been sending some questions our way about how can I use cash value life insurance to grow my wealth? How does it fit into an overall plan? And of course, our answer is always, well, work with us and we can help you with that. But, we're here to add value to everyone. And there are some doctors like Luke who make a very good income, but they're not quite there yet at the level where we can save them enough. But we still want to help them on their journey, knowing that they will get there. So I told Luke we'd cover it on the podcast, and I'll be excited to send him this episode. So Bob, I know some of the things you've shared with our team about how you can use cash value life insurance has blown me away. And we were on a call yesterday with a member, husband and wife, and he said something like, it seems like magic. Like it really does. So I don't know if we can give all the secrets away about how we use it, but I'd love to hear, it kind of gets a bad rap, right? Like you hear the Dave Ramsey's like, oh, you shouldn't have cash value life insurance. Is that true? Again, like everything else, there's nuances. So I'd love to hear your take, Bob, on cash value life insurance.
Yeah. So you're so right. I mean, it's like the Hatfield and McCoys. I mean, it is one of those topics where people, their faces turn red, right? Voices increase. And I think the first thing that we need to discuss is you are different than anybody else. As a physician, you cannot look at generalized conversation and topics and advice that fit you. So for example, Dave Ramsey, Susie Orman, and a handful of other people. And there's also a lot of physicians. There's White Coat Investor, who is an ER doctor who went down this pathway, and everybody's in a different situation, have a different understanding. But one thing I realize is that if you look at your scenario and your situation, there's a reason why there's different products and different tools. So if I were to go build that house behind Joe, I could not just build that house with a hammer. Just would not happen. It would not look like a house. It'd look like art, right? Very abstract. I'd have a hell of a time. It'd be so much fun just swinging a hammer all day long, right? But I can't do it. So there's different tools to create that outcome you're looking for. And the same is with the financial, investment, banking, as well as insurance. We have different tools. We have term life insurance. We have whole life insurance, which is part of the cash value life you're talking about. We have different types of universal life, which is part of that cash value life you're talking about. These are all different products that are used differently to create an outcome that is specific to you. And so even within cash value life insurance, like whole life versus universal life and the type. Even within universal life, do I index versus variable universal life? I mean, there's a lot of opinions that fly around, right? If you were imagine a cage full of boxers or fighters, there'd be fists flying everywhere. And we're a little more civil than that, but you kind of get the picture of this. There's a lot of passion around this. When you're going to hear from us, we try to separate some of the passion with some of the logic of usage of assets. Because you can have this conversation within real estate and find some passion within real estate as well, which everybody loves. Everybody wants to get in real estate. But where? How? What do I do? How do I use it? The same thing when it comes to cash value life insurance. So first thing we need to think about isn't an asset? Well, let's go back to Robert Kiyosaki's definition of an asset. And the reason why I like to use Robert Kiyosaki's definition is because it's very simple. And most people have heard of Rich Dad, Poor Dad, have read his books. So he says an asset is something that appreciates and grows in value. And it could actually create income at the back end. So, okay, so cash value life insurance, as like real estate, accomplish the same thing. Cash value life insurance is a lot like real estate. It's just a different type of asset. So, for example, a house has a value to it. Cash value life insurance has a value to it. It's called death benefit. Okay. Now, you can get a loan to buy a house, or you can pay it by cash. Same thing with cash value life insurance. You can actually get a loan, or you can pay it by cash. You could borrow the equity out of your house that's in there, and it's a non-taxable event. It's your equity. You can borrow the equity out of your cash value life insurance, which is a non-taxable event. Here's the interesting thing, though. Here's the difference between the two. Real estate, if you borrow the equity out, who do you get the money from? A bank, a financial institution, which has a cost to it, right? Interest. And if you're not sure what that means, go watch our Pay Off Your Mortgage episode that we've recorded to see what we mean by that cost of that. But the bank is going to collateralize that, and you're paying the bank interest. Well, on cash value life insurance, there's no bank. They're going to collateralize the death benefit. Okay. Well, the bank's going to collateralize the house, but the insurance company is going to collateralize the death benefit. So what that means is that your payment structure with cash value life insurance could be more flexible. Is there a cost to borrowing it? Of course there is. But there's different ways to borrow it. There's ways to where you can borrow it where you actually have your cash in hand. And when your policy grows, the cash value, the equity grows, it subtracts out the money you've had, right? Which is what normal people would say, well, yeah, duh, that's how a loan works, right? But there's also ways to structure it where the policy still appreciates and grows, the equity grows in value as if you never took the cash out, but you did. Why? Well, because the death benefit is collateral. So if you were to die, the insurance company just takes the loan off the death benefit. So it's secured. Over here, you could actually get foreclosed on. What's the worst case scenario on the cash value life insurance? Well, you don't pay the loan back. You don't pay premiums. Your cash drops and your loan becomes a taxable event. Okay. What's the worst case scenario here? You lose your house. Okay. So there's risks to both, but there are some flexibilities and purposes to both. Your cash value life insurance can't create an income stream like real estate can, because you can rent it out and other people can build it. Cash value life insurance isn't going to do that. But you could use your cash value life insurance, the equity in that, to actually buy that real estate to create that income. So this is where you hear on the cash value life insurance side, bank on yourself or your family banking, that kind of stuff. How to use your cash value life insurance as your own bank and own finance vehicle. This is where I think there's a lot of misunderstanding. And I think some leeway with certain insurance companies to use that as a sales ploy. Because to your point before, Joe, when we were talking about vehicles, cars, trucks, they're expensive, right? The cost of vehicles have significantly increased. So if I was just sold a life insurance policy that builds up cash value and an agent said, hey, you don't even need to go finance that anymore. You finance it yourself and pay yourself the interest. Well, do I want to build up $100,000 in my cash value life policy to go buy a brand new vehicle that we know depreciates the moment you drive it off the lot? But I get to pay myself interest. Yeah, but that debt seems pretty expensive now because that vehicle doesn't have the same value as what you paid for it, right? So that's the pitch of banking on yourself and that sort of stuff. pay for college education for kids. Yeah, okay, that I can see that. That makes a little more sense than going to buy a vehicle. So we choose to use this asset, cash value life insurance, as an asset to create other assets. It is, if you're going to go in debt, and this is where Dave Ramsey and Susie Orman are correct, to have bad debt, credit card at 30%, right? Have a car loan at 9, 10%, right? You have these other personal debts do drag your wealth down. They are absolutely correct. But to have a debt in an asset that creates other assets, isn't that why you bought your original house in the first place? That leverage? Because it benefited you to have a house. Why people call it an investment, but go watch that mortgage episode that we recorded previously. So cash value life insurance is an asset. Well, Bob, but it's life insurance and it has a death benefit. Absolutely. And based on the IRS tax code and the rules, that life insurance actually creates a guideline of why you're able to take and utilize the cash or the equity out of the policy tax free. It also allows you to be able to access, so some agents will sell it as a tax free income stream. Build up, pay your premiums, build up your cash. And then when you hit 65, 67 years old, you actually start taking a tax-free income stream because taxes will be higher, right? Yeah, they may be, they may not be. I don't know. I definitely know inflation over the years will make my value of my dollar lessen. So I'll have to have more income. Therefore, my taxes will be higher. Right. And that's basically what Economic Termites, my book, and some other episodes we've talked about discusses the correlation between taxes and inflation. So this asset helps us to hedge that. So if you're hedging that, go ahead, Joe.
I was going to say, I think a lot of the passion around this does come from exactly what you said. If all you have is a hammer, everything looks like a nail. If you don't have any hammers, then nothing looks like a nail. And so when you hear the talking heads in this industry talking about these things, I think some of what they're railing against are the people who all they have is a hammer. And so cash value life insurance applies to everybody. You're foolish not to have it. And then they have to push back equally hard and say, you should never have this. It's expensive. You know what I mean? Like, I think that's part of where this passion comes from, is you have two entrenched sides whose incomes depend on them being correct.
Yeah.
And we take a very different, as you can imagine, if you listen to this channel for more than 10 seconds, we take a much more holistic approach. We're looking at this as, is this an appropriate tool for you, doctor? And understand that the Susie Ormans and the Dave Ramseys of the world, they're not talking to you. You need to be aware, you are not their market. Their market is the vast majority of Americans who make probably, Bob, what would you say their demographic? Less than $200,000 a year of income, who are kind of trying to figure out how to do life. That's their demographic. It's not you. And so you have, just like, and I think, Aaron, when you're talking about opening up this episode, I think part of the reason why so many doctors' lives or views about cash value life insurance are impacted, it's compounded by the fact that they've probably been sold this stuff in the past. So when they were, 32 years old and kind of just, beginning in their practice and moving in that direction, here's a new opportunity and the right person brought them aside and they're like, here's what you need to do. And not all insurance is the same. There are different ways that insurance agents can make money, and some of those mean that you're paying some fees that you wouldn't necessarily have to. Just not everything that you buy is exactly the same. You can get the same impact for less money. So having a team like Terra Firma who is speaking into this from a holistic perspective, we have all the tools in the tool belt. We don't just have hammers, we don't just have screws, we have different variations of hammers and screws, right? I can just see, Bob, that house that you're talking about, so many houses that have been built by just a hammer or just a saw. It's like that. It's a really good illustration. That's not what we do here. Our job and what you deserve, Doc, is you deserve a team who is working that hard to find the right tools to build the home that you want, not the home that they want. So important distinctions.
Yeah, no, I think it is an important aspect of the decision-making process. Because a lot of the docs, when they do come to us, to your point, Joe, is that, well, I've had this. I don't know
Mhm.
why are we spending this much money in premiums? What's this for? Right. So they
Right.
understand the life insurance part of it and replacing
Hmm.
income, but they're like, well, this seems expensive, right? So this is where we come in and say, okay, well, let's look at it from an asset, and we start having this dialogue and this conversation. We show them how to use it in other scenarios, right? And I think a lot of times that gets lost. And also, the insurance, the finance industries, they're tough industries to survive as an agent or an advisor to make money. It's a tough business. And so a lot of times when we look at these statements from our doctors, the servicing department is the insurance company, meaning that the agent is no longer at that organization or no
Mm.
longer in the business. So they're
Right.
not having the advice of when it's the next step to be able to take this cash and use it as a asset. But here's where I think the best illustration of why this is an asset is the banking system. Every major bank uses these policies for their executives, for their balance sheets on the banking balance sheet, and that is representation of their cash. A bank cannot have cash on hand because it's considered a liability for a bank. A bank, cash is an asset and it needs to be loaned out to create revenue for the bank. That's the premise of a bank. So when they have these cash value life policies, because of the liquidity as an asset class, they can use this on their balance sheet, meaning they have less cash that they have to put on hand that they can now lend out. This is an important distinction. So if this is what the banks are doing and they're turning $1 into $10, why can't we use those same guidelines and rules for ourselves? We can. It's the same rule. That's the thing people don't understand. Everyone wants to say, oh, they have those rules and they have those rules. No, this is a legal system. Everybody has this access to the same rules. Sure, you have to stay compliant with certain nuances with some of the rules and some of the areas. Absolutely, right? It's not the Wild West. But based on your situation, 9 times out of 10, Doc, based on your situation, you have the same access to the same rules. And so it's just a matter of understanding your situation and does this work? Now, is whole life better than universal life and the different types? I don't know if it's better or worse. The reason being is that your situation is going to be different than others. So a lot of our members actually have all three policies. What do you mean all three policies? Term, because it's cheap and it does a lot of heavy lifting, right? So if you have young kids, you have a high mortgage, you're getting started in your practice, you have a higher expense that if something happens to you, you want to make sure your loved ones are taken care of. So yeah, it makes sense to have term to do the heavy lifting because you get more death benefit for a cheaper price. Totally makes sense. But if for an insurance company, that's the ATM machine because they pay out about 2% of the policies. Not because people don't die, it's because not enough people die because most people are younger when they have that.
Hmm.
So they have their own cash machine going on. Whole life versus universal life. Why? A lot of our members have each of those based on their outcome of what we're trying to accomplish. And we use each asset differently, just like stocks are different than bonds. ETFs are different than stocks, than
Well, and I
mutual
think
funds.
I think a lot of this the I think the rub for a lot of people, and what I hear from like Dave Ramsey specifically when he's railing against cash value life insurance, he talks about it being expensive. That's one of the things that he talks about. And the other is, you hear him say this a lot, is your investments should be investments, your insurance should be insurance. And I think Bob, I think a lot of people don't know what you know about how you're using these things. Yeah, if you're just, because what's a cash value life insurance policy investment return? 4%, 5%, maybe.
In whole life, 4 to 6%, depending on the
Yeah.
carrier.
So low. So if all you're doing is using that for investments, yes, you're correct. That's not the best investment return that you can get. Is it secure? Yeah, it's probably one of the more secure things that you can have. But if that's all you're using it for, is you're putting money in and that's the return, Cool. Dave's probably right. There are just other ways to use that where you can
Be-
invest
be-
differently.
yeah, because you use the word that he uses, investment.
Right.
Investment is different. Even if you look at Warren Buffett doesn't have just investments. He buys assets. Berkshire Hathaway owns companies, and then they also invest in their investment portfolio percentages of other companies that they don't own the whole company, right? So if you treat an orange and you have an apple and you're saying, hey, you know what? You can't, everything's got to be this orange. Yeah, he's right. An orange needs to be an orange, an apple needs to be apple. So that's why we're very specific when we call it a asset. A stock, bond, mutual fund, a brokerage account is a asset, right? They're assets. How you use the assets determines, is it an investment or do we use this asset for another purpose? The
Mm.
goal is to grow the value of your wealth, not your net worth, the value of your wealth. Because and this is why this is the distinction. When we look at companies, so like Apple, do you and I know what their revenue is? No. We can go and look it up and, go in their financial statements, look it up. Do you and I know what their profit is? Not until they come out and say, oh, we made this much profit this quarter, right? As a public company, they have to report that. But what do we hear the most about most companies? Their valuation.
Mm-hmm.
Apple is a $2 trillion valued company. It's going to be the first company that's 3 trillion, right? Well, that's different than the revenue and profit they make.
Mm-hmm.
The same runs true for you and I. We have a different value. That's what life insurance actually is trying to underwrite for. The death benefit is trying to underwrite for your future value, and they use income, they use your mortgage, they use all these different forms to determine what your value is at death between now and when that happens. If it well, not if it happens.
When it happens.
Right. It's 100%, right? When it happens.
That got morbid real quick, but we're
Yeah.
talking about life insurance, so.
But that's the whole point that we're bringing up, is that what's the value of your business, of your value of your assets, you included, right? And can we use that valuation to grow your underlying profit and net worth? Yes. How? That's the whole point of this channel.
Okay, so for someone starting out or who doesn't have any cash value life insurance or isn't at a place where they can work with a team like Terra Firma, where's a good place to start? How much? How do you assess whether it's the right time to get into it?
Yeah. So, I mean, I wish I just could give you just a straight answer. It's hard. I'm not in a position to give a straight answer because we do things with a certain purpose of looking at all the different holistic aspects of somebody. But if somebody was looking for something, well, you need to make sure that whatever you're putting in as a premium is part of your cash flow that you're comfortable with not using. Right. You don't want to say, oh, yeah, I'm going to do $3,000 a month into my premium, and portion of this does pay for death benefit. There are expenses. There are commissions that go out to the agent, that sort of stuff that are put in there as part of the expenses. And then the remaining amount does go into the equity or the cash fund, so to speak. If 3,000 is pushing it, well, don't do 3,000. You want to set it and kind of leave it, so to speak, meaning that you're comfortable with the premium amount. You can add some extra down the road, depending on how they structure it. The other thing is, are you using this for life insurance or as an asset? There's a difference. So life insurance is that you're running the premiums based on the death benefit and you're trying to get as much death benefit as you possibly can. Well, to Dave Ramsey's point, then yeah, it could be expensive, right? You're buying basically lifetime term, right? So it will be more expensive. But if you're looking for cash value, I just want to accumulate as much as I can. Will they bring the death benefit as low as possible? Your premium can still be the same as if you're just doing life insurance, but a larger percentage will go into the cash bucket. Okay. And there's guidelines that we have to follow within the insurance and IRS tax code that you have to follow. And you can't overfund in the sense that where the policy becomes a savings vehicle. There's a certain terminology called modified endowed contract, a MEC policy. And that's what that means. So, or a hybrid between the two. This is why we use term insurance, is because we like to accumulate cash. So we like the death benefit as low as possible, get our premium growing and appreciating and building the equity within this asset class. But I still need death benefit, Bob. That's when we stack a term policy on top of it. It does the heavier lifting, it's less expensive, but I would get a policy that's convertible, meaning that you can turn that and convert that into a permanent asset or permanent life insurance policy. Okay. And each company's different. So, but that's important because your premiums, a lot of times with the convertible term, they'll actually give you credit to your premiums when you convert it. So not all your premiums are lost. Right. So I think I probably just confused everybody even more, but that's to Joe's point. There's a lot of companies, there's a lot of policies, there's different points and different purposes. So, I mean, at the end of the day, those are the main goals that I'm looking for, right? Is your motivation. Okay. And if you're single, well, you may not need the death benefit now. You may just want to focus on building it as an asset. Right. And when I say single, meaning you don't have responsibilities, you don't have any children or any of those types of responsibilities. Right. But if you have high debt and you're single, don't have children or anything like that, and your parents are your beneficiaries, well, you don't want to leave them with your high debt. Right. Because the financial system is going to go after your heirs, right, for what you owe. So then you may want to so you have to really assess your situation and see, if I'm not here, worst case scenario, you die. Right. That's horrible. But you are, but everybody else isn't. And someone's going to go after and try to grab what is theirs that you owed them. So that's kind of the responsibility of life insurance. So those are some of the factors. I don't know if I just made things even more confusing, but this is why this is such an emotional conversation. Why, so to speak, those fists fly in a ring, because there's a lot of moving parts. It's not just, hey, do this. Oh, you can buy a vehicle, do this. No, there's a lot of moving parts, and this is a important decision that shouldn't be taken lightly.
I think oftentimes when we're talking to doctors who are not quite at the place to work with a team like Terra Firma, they're typically early. There's a couple reasons for it, but they're typically earlier in their career is one of those reasons. And to Bob's point earlier, it's likely like cash value life insurance is not the right tool for you right now. A term policy is, until your income is at a place where you can make that investment on a regular basis and you have all those things. So, for Luke, who's asking this question, that might be the solution, is just find a really good term insurance that allows you to get to a place in your career where you are now, you no longer have that responsibility because everything is taken care of. You've built enough assets to cover your family and do all of those kinds of things. The other reason someone is in that situation where they're not ready to work with us is they're spending too much. They need to modify their lifestyle so that they do have that surplus income every month. And so those are not easy decisions to make. If you ask somebody to intentionally reel in their spending so that they can build more assets, that's very against the ethos of America, right? America is like spend more. It's the comparison with the Joneses, right? Living up, to what they're doing. You're looking everywhere else and saying, "Oh, I want that house or I want that car." That's a very real thing, and there are literally trillions of dollars in advertising trying to extract that money from you. And so I think that's the thing that these doctors need to pay attention to. One, it just make sure you have a team who has your best interest in mind. And Bob, maybe you've got some like, what are the questions that someone like Luke could ask an insurance agent to find out, am I getting taken or is this a good deal for me?
Yeah, so that's a great question. I think a lot of it really is dependent. So, like in the doctor market, Northwestern Mutual is a big market.
Mm-hmm.
For the, and And because they do have a great disability policy, and then you might as well get a whole life policy, and that's usually the 1-2 combo, the bundling, right? Progressive bundle, home and
Yeah,
auto,
right.
bundle your disability and life.
It's true.
It's true, but I think you bring up a great point. Is that this is where I think if that Dave Ramsey conversation actually is right. You're at the beginning stages of your practice, of your career, maybe term, and building up a side equity fund, meaning your brokerage account, your savings, building that up to where you have that reserve is probably more valuable for you right now than having cash accumulating in a cash value policy, because it is more expensive, and it really is something that's designed, really should be designed to build up as an asset, which means that you have more available on a day-to-day, on a month-to-month basis to put in there.
Hmm.
So I think that term and kind of invest the difference, so to speak, makes sense, meaning that your cash reserves. But also, if you're a physician and you're just getting started out, you're probably about 2 to 3 years away from working with us.
Hmm.
And with that in mind, we'd be able to look at all those assets and put a plan in place that will allow you your hard work that you just put in place for 2 to 3 years into the next stage, and enhance that plan to accomplish these things you're asking right now. Um,
Hmm.
you're also very correct in the sense that if you are making a good income, meaning you're definitely in the top 1% of income earners, but your spending habits match your top 1% of income earning, um, to utilize a cash value life insurance policy in your life, I think is irresponsible as well. I think you're essentially, just like a physician's just starting off. You really need to have term insurance to carry that heavy lifting, make some very purposeful changes in your spending habits
Hmm.
in your life to put you in a position, in a situation. That opportunity cost of, oh, but Bob, I can have this cash accumulate, that opportunity cost is too great.
Yeah,
I
it's
really
like
think,
free. Yeah, I have found that freedom is in the margins. And most of us live with no margin. We live with no time margin. We live with no financial margin. We live with no health margin. It's part of the reason why I have such a strong focus at Terra Firma on coaching the whole human being. We're looking at everything. So if you have such tight margins, that adding to that is going to increase your angst. It's going to increase your anxiety. Create margin, create peace. That I think there's some really, really important things. So again, Luke, who asked this question, hopefully you're getting some good nuggets from this, and hopefully you have some real things to take away. But what I'd encourage you is, like, be intentional with what you're doing. Put yourself into a position. You're a doctor. Put yourself into a position to be able to work with a team like this by making whatever lifestyle choices you need to make in order to create that margin.
Thank you for all of that. I learned so much on every episode, which is amazing, but you can see why so many people are completely overwhelmed and confused. And
Yeah,
when I talked,
right.
use the word paralysis. He goes, I've just been sitting in paralysis because there are so many options. I don't know who to work with, who to trust, where to put my money. I mean, it is overwhelming. And that is why we're here. And yes, I loved being able to do this, to speak to that person who is maybe just starting out, and how do we use this, like enlightening them on how this
Hmm.
is. I think another episode in the future can be speaking to those who have built up a lot of cash value life insurance because, like you said, it's something that they were sold 10 years
Hmm.
ago, and now they
And they
have.
don't know what to do with it. They're like, what do I do now?
Exactly. And I've seen this firsthand where Bob sees it on the asset map and enlightens the member and shows them how they can use that money, and then it still keeps appreciating. And
Yeah.
that's where wow, that's like magic. The insurance person didn't teach them that. But now Bob is here to teach them that. So I think we should do a follow-up episode on what are some options if you have this sitting here. Let's use it,
yeah,
to grow.
Totally.
yeah. I think the key is being very purposeful, and that's why terra firma is what it is,
Hmm.
right? For that confusion. right? I did not like that. I felt that was
Right.
very frustrating.
Yeah.
And why all of a sudden the light bulb goes off and says, oh, well, don't just focus in this sniper. The riches are in the niches, right? Is what they say, right? Be a sniper, not a shotgun. I'm like, well, what if I have a team of snipers, right? And we handle it all, right? And that's the holistic aspect I have found to be much more beneficial, and it fits my character. If you're watching this, as you can tell, I love this. This is so much fun because I learned this stuff from your shoes. Right? I am
Right.
interested in this. I want to know the answers to this. I want a productive, positive solution to this. And if I do, there's got to be other people like me, right? And that's just that's our nature. We want to serve you. So, anyways, I can go on and on, but we gotta probably end this episode at some point, right?
I love it. Thank you so much.
Filibustering.
All right, Luke, thank you for submitting the question. Doc, if you're listening and you have a question, please send it our way. We would love to address your questions. We'd love to talk to you and tell you how we can help make a big impact in your world. Thank you for listening. Until next time, go be a wealth maverick.